Hey everyone, this is Mish, Chief Strategist of marketgauge.com, and it's going to be kind of a nutty week. We've got CPI, FOMC, the NVIDIA stock split, and so forth and so on. And I kind of kept thinking in my mind over the weekend about a Gordian knot. So what's a Gordian knot? It goes back to Alexander the Great times. Basically, it was an ox cart knot that was whoever could untie become the ruler of Asia. Now, really what it's become in modern times is a metaphor for something intractable to solve could only be solved by a force, by a brutal force. And so that made me think, what can we do here? We've got people who are so negative in the market. Harry Tent, for example, the latest one to come out saying we're going to have this major crash. And then we have others that have been extremely bullish, thinking we're going to 5,400 and eventually 6,000 on a strong economy. But what we know right now is that we don't know. And that's where the Gordian knot comes in. We've got the possibility of recession. We still have the possibility of higher inflation. We certainly have a lot of geopolitical factors all over the place. And most likely we have a Fed that's going to do nothing because they still themselves don't have an answer about what to do. Should they risk more inflation to avoid recession, or should they allow recession to happen and therefore really solving the inflation problem? So I thought today we should discuss this through commodities, but I wanted to start with the dollar euro because it made a huge move, the dollar against the euro, today, Monday, as I'm speaking to you. Why? Because this is one of those geopolitical soups that is very interesting, as Macron, for example, is now fighting to hang on to power and is actually considering a new election to see whether or not he should remain in power if that's what the people want. And this is the sort of populism pockets that we're seeing throughout the world, which is definitely an inflationary thing, even though the dollar reacted strongly against the euro. So I would keep my eye there because two reasons. One is it'll be a good gauge of what happens in euro. Two, we'll see what kind of damage a stronger dollar does inevitably for our market and whether or not that does anything for the Fed. And for three, if it winds up failing from here, then that tells you that there's problems all around, still with the euro, but also with the dollar as well. And that would certainly be kind of a head scratcher. So if you look at the dollar chart right now, you see good resistance to the dollar versus the euro at around 93.50. And if it gets through there, then that definitely means the dollar will get stronger and more problems in Europe. And that, of course, will affect commodities, which we'll talk about. And under 92.40, I think that we can say that the dollar is weakening. And, of course, that also will be bullish for commodities. I guess you can probably tell that no matter what, I'm bullish on commodities. So let's start with gold. So we saw this great correction last week. And, of course, all the bears came out. Gold is over. I just think this is the normal volatility that happens in commodities. And if you looked at the top of the chart in the cash futures of gold, you had sort of a classic reversal top, what we call at market gauge, a brick wall top, and yields a 5 to 10% correction. We've already had about a 7% correction. So I'm looking at 2280 on this chart as the major support level, 2300, which is where we're trading at as I talk to you, pivotal. And if we get through 2350, then you have to say to yourself, okay, gold's still strong. Whether you care about the reasons or not, that would obviously tell you that gold has more upside. If we move over to silver, silver is actually outperforming gold, which is a good thing for silver, number one, and it has industrial uses, number two. And of course, things I've talked to you in the past about AI usages being a strain on raw materials. That's part of the reason silver is looking better than gold and also could be sign of inflation, right? So 2875-ish is your support area on the silver futures chart through 29. We can hold up there. I think if we start to get back over $30, especially $30.50, that also would be a sign that this high at $32.50 will be a very short-lived resistance. Now, I wanted to talk to you about another metal because there's been a lot of talk about copper. And of course, copper is probably the premier metal that's going to be used in all of the AI technology, the supercomputers and the data centers. And copper also had a nice little correction. So you can see it's back under in this cash chart under the 50-day moving average. I think if it can get through 460, That will not only bring it back over the 50, but tell you copper's ready to make another move up. We have support at around 420 at this point is really where I would keep an eye on to see if we get any other further weakness. Which brings me to two more interesting commodities, one being oil. A lot of people are saying to me, Mish, how could you possibly think that there's any chance of stagflation if oil is not expensive? Well, yeah, that was the 1979 mindset. To me, the mindset for stagflation in 2024 is completely different and not oil dependent. That's why we talk about technology and data centers and the strain on raw materials and the precious metals and all of those things that are doing way better than the grains, for example, or even for oil. But I still think we have to keep our eye on, well, it looked like it had a reversal if you look at the chart here. And this is West Texas. It had a nice reversal. $74 a barrel is now your support. And again, if it gets to $78, even though 80, 81 is still resistance, you have to think to yourself, oil is stronger in the face of what many people thought were weaker fundamentals, which kind of takes out the recessionary idea and puts us more back into the stagflation idea. That's why I keep going there. And the last one I wanted to look at is one that most people don't look at very much, and that's sugar. That's always been my classic barometer because of many reasons, not the least of which is that it's in everything. And so it's been trying to base as well. Now, it looks like 18 could have been the bottom. That's 18 cents a pound. Now, remember, 2020, sugar was at 5 cents a pound. So it still has gotten a heck of a lot more expensive. But now, if it can get through 1950, and then especially if it gets through 20, you have to say to yourself two things. Number one is there a good cheap buy opportunity in sugar? Number one. And number two is why? Okay, and that goes back to geopolitics. That goes back to the potential of Mother Nature as we're entering, another La Nina in Europe and also here in the States, droughts and floods and hurricanes. And then really what it does tell you is that there is no one statistic, getting back to my Gordian knot, that could necessarily be the brute force. It's going to really be what happens more on a global level, even though we've been trying to see a deglobalization. And that's clearly what's happening as well. Also inflationary. Okay, that's it for now. You all have a great day, great week. And remember to watch those commodities. Bye for now.